I'm loving the illusions I'm getting. Lawrence Summers, it's like 2009. I'm getting a little bit of 1998 love now. Where are you on this? Can we look back, or is it the immediate present that we have?
No, I think, well, this time, famous last words, this time is different. When I look at it this time, I was thinking even earlier this week, I never thought I would be in a market where you'd have a 10-year yield that hit 160 this week, with unemployment below 4%, with GDP growing above trend, with everything actually looking reasonably good. So it's pretty shocking where we are in the bond market, and yet also hitting all-time highs within the last few weeks in the equity market. So when I look at the market, I'm trying to figure out what is the relationship between bonds and equities telling me. Either the bond market is saying there's a recession, which the equity market is ignoring, or number two, perhaps the bond market and the equity market agree that central banks will do whatever it takes to put a floor under stock prices. So the bond market's betting on lower rates, equity market's betting on propping up financial assets. Or three, could there be a worry about competitive devaluations? Maybe that's what the bond markets see with all these rate cuts around the world. So I'm trying to figure out if it's one of those three things or just something else I haven't considered.
We're going to talk about this through the hour, but I want to go, this is like, you're a Duke, Fuqua, and it's like basic 101. Here's the yield, flip the reciprocal, that's the PE. That rules out, or is it?
I don't know that it's out entirely. I do think lower yields can justify higher valuations on equities. I mean, it's the whole TINA phenomenon, right? There is no alternative. And so when I look at asset allocation, if I look at sovereigns and I look at credit, I don't see an appealing trade, or put differently, I don't see an appealing investment. There might be a trade there. You might get a 10-year yield that goes to 1%.
Lazard doesn't trade. You do investments.
We're investors. Yeah. When I look at investing, I'd much rather own equities and find high-quality companies.
Francine?
What about gold?
I cannot get my intellectual arms around gold. If you can tell me how to value gold, we'll talk more about that one. But I do see a place, by the way, for real assets, for income-producing real assets, maybe property or other infrastructure-type assets. So I think there's a real case to be made if rates keep doing what they're doing, that people are going to have to scramble for a different type of asset, perhaps in the illiquid space or in liquid real assets.
Ron, we're actually talking now about the U.S. possibly intervening onto its currency market. What is the likelihood of that? Is it just market rumor, or is it something that you would be actively looking at? And if there is intervention on dollar, what does it move first? What asset class gets hit?
I think we're likely to see jawboning on the dollar. I don't think you'll see actual intervention. I mean, the actual intervention would be somewhat difficult, I think, to execute. And I'm not sure we could actually do enough in terms of intervening. And I think it would actually be a pretty negative precedent. It's already risky enough seeing other economies basically thinking they have to devalue. I think Mario Draghi is already in a very tough place in terms of almost having to lower rates or ease in some way. And the poor man is frankly pushing on a string at this point. There's not much dry powder left at the ECB. So I think it's a pretty dangerous thing to do if we start trying to intervene in the dollar.
I want to come back to negative rates and the challenges of Europe in the next section. Ron Temple, this is absolutely critical. David Kostin of Goldman Sachs yesterday told us it's a service sector buying economy. Forget about the world, buy the service sector in the U.S. You know the one-way overloaded play right now is defensive.
Right.
Are you defensive, or do you have to have the courage to do something different?
I don't think there's anything defensive about overpaying for a stock. And so when we're looking at stocks, we're looking security by security at their fundamentals and valuation. And I think a lot of these defensives, are actually very expensive. I tend to think we should look at other sectors and try to focus on companies with enduring competitive advantages that can sustain their returns even if you have a downturn. And I don't think you just have to look at utilities and consumer staples to get that. Although there might be some specific consumer staples you'd like, we're basically trying to be very careful about which specific securities we're going to buy.